Hey guys, I'm Eric. I'm a finance manager at a major tech company, and welcome to the Personal Finance Diaries. Here we talk real money, savings, debt, and smarter financial decisions. Today's topic is comparing personal loan rates, specifically the numbers that actually matter when you're shopping around. I've loved personal finance ever since I was a kid, so I'm super excited to break down this topic for you guys. If you're watching this video, you're probably in the market for a personal loan, whether it is buying a car or getting a mortgage on a house. You're watching this video, you are interested in getting the best rate and the best deal for yourself. As I've done in the past, I'm always looking for the best deal that I possibly can get. And so I want to walk through what are the best ways that you can start incorporating some of the things I want to teach today to help you get the best deal and to also save you some time, because it gets kind of complicated when you start going and applying to specific loans. I want to make sure that you don't actually end up hurting your credit score. There's a lot of different factors that you got to go into play. So I will walk through all of that in this video today. When you're getting a loan, one of the most important things to pay attention to really boils down to APR versus interest rate. A lot of the times you think they're interchangeable, but they're actually quite different and they mean completely different things. And so I'm actually going to break down why that matters, and then go into a direct example of how you can use this to your advantage when you're shopping out for loans and ensure that you get the best deal and you know all the different considerations to think through. So let's go ahead and break down a simple example. Let's assume that you are buying a house, and I'm actually going to start sharing my screen and we'll break it down directly on, we'll go on Zillow and then we'll walk through it through a spreadsheet, how the math actually plays out. Okay, so we're here on Zillow. Let's see which house we're going to just use for an example. Do something like this. 310 is in Orlando. Okay, and so let's assume that we actually negotiate, right? Because we want to negotiate these prices down, and we get this house for $300,000. Now you can go on Zillow and you can actually pull this specific mortgage and how that works, but I actually have a mortgage calculator right here. So we're gonna assume, just for the purpose of this, that the house is $300,000, okay? And we are gonna put 20% down, okay? So that means that the loan amount is $240,000. Your interest rate, nowadays, let's just make it simple and we're gonna say 6%. This number is completely different than what the actual APR is. So the main difference between these two, the interest rate and the APR, that you're gonna see people and different people that give out loans, the lenders, what they're gonna explicitly say. The APR includes the origination fees or any other fees or administrative fees that lender wants to charge you. And that's super important because it really gives you the true amount that you're gonna be paying for getting into this loan. Okay, so I opened up a spreadsheet here so I can break down the main difference between the APR and the interest rate, because this is super important to understand what to look for when looking at a loan. So like we talked about, purchase price of the home is $300,000, okay? 1, 2, 1, 2, 3. Go ahead and make this all dollars and let's get rid of those decimals. Okay, so purchase price $300,000. We're gonna put a down payment of 20%, which means that the actual loan amount ends up being this times really 1 minus this. 240,000 is the true loan amount that we're getting after putting this 20% down payment. Let's assume that the interest rate, which is different from the APR that they're charging us, is 6%. And to make things super simple, because it really depends on the term of the loan, how often it's compounding and how long of a loan it is, we're gonna make it super basic and just assume this is a 1-year loan, okay? 1-year loan. That 1-year loan at a 6% interest rate would cost you about $14,400 in interest paid for that $240,000 that you're getting a loan on in that 1 year. Now, how does an APR differ? Well, the biggest difference between the interest rate and the APR is that it actually charges you or takes into account the origination fees, the administrative fees. These are the things that the lender charges you to start this loan. Usually this can vary. It can be like 2%, it can be 8%, it can be a lot. So it's really important to pay attention to the APR instead of the interest rate. So you're looking at things apples to apples. Let me show you how this would break down. So same house, same everything, right? But the only difference is that I'm gonna put interest paid. This has 0 origination fee. This one charges you a $5,000 origination fee, right? Let's do this. This $5,000 now gets added to the total $14,400 that you're paying, right? So what you actually end up paying after everything is said and done, is this 14,000 plus the 5,000, you're paying 19,400, which means the true interest APR, right? The true APR, for this specific loan is this divided by the true loan amount. So when it's all said and done, what you actually paid was 8% instead of the 6% because of this extra 5,000 that got added on top of the loan. And so that's why it's super important to compare interest rate and APR and know that APR is probably your best bet because it takes into account any of those pesky fees that the lender wants to charge you. Now that you have this, how do you actually go about going through different loan options, right? How do you shop for loans? Well, the one thing that's super important to keep in mind is your credit score. Credit score is everything in America, right? You really need, your credit score allows you to get a better interest rate. If your credit score is, I don't know, call it below 580 or even like 600, you're gonna get a much lower, a much higher interest rate. Your interest rate could be 7%, and one extra point makes a massive difference. Let me show you. Let's say instead of 6%, it becomes 7%, you just pay $2,000 more, right? 3% indicates $5,000 more, right? It makes a massive difference, especially when we're talking about a big loan like a house, for example, or a car. I mean, we can break it down right here. Let's assume the same thing, 300,000, 20% down, $240,000 loan. At 6%, we calculate this, you are paying a total of $278,000 in interest. If I just increase this to 7%, it doesn't seem like a lot, it's just 1 point. It goes from 278 to 334. You're paying close to $50,000, $60,000 in additional interest over the 30-year term of the loan. That's huge, and it can make a massive difference. I mean, that's sending your kids to college even, like it could be a new car. It actually adds up a lot. So that's why having a good credit score is critical. And so how do you actually ensure that you don't affect your credit score when you're applying for a loan? Well, it boils down to this. A lot of the times when you're looking for a loan, you might actually go and shop around different lenders. So you'll say, hey, like I go to, let's say, I don't know, you go to your local bank, you go to Wells Fargo, you ask for a specific, you actually apply for a loan, you go to a different bank, you go to a different lender, and you go one by one. Now, the big problem with this is you waste a lot of time, and you gotta be super careful that they actually do a soft inquiry on your credit report. What that means is that it doesn't actually impact your credit score at all. You're basically pre-qualifying for that loan. So whenever you're looking for an actual loan, you need to make sure it is a pre-qualification and not an actual application for that loan, and assume that it's a soft credit check, like check that it's a soft credit check. This ensures that you're not actually doing a hard inquiry. A hard inquiry would actually impact your credit score. Every single time that you apply to a specific loan, your credit score is going to get impacted and it's going to go down. And then by the time that you actually decide and you keep applying to places, your credit score is going to keep going down, and then your interest rate that you're paying is going to start going up. So that's not what you want. You always want to do a pre-qualification. You want to kind of shop around, get an idea of what's out there in the market, and only do soft credit checks. So that way your credit score isn't impacted and it can stay relatively the same throughout this process. Now, this takes a lot of time. The last thing you want to do is go through a bunch of different lenders one by one, trying to identify which one gives you the best rate, which one gives you the best APR. Instead, you should use a website like Best Money. Best Money has all these different options. You can look through mortgage loans, life insurance, pet insurance, debt consolidation, personal loan, online banking, and even credit cards. This is the best place that you can go to actually compare the different interest or the different APRs of the loan options. So let's assume that it is a personal loan. And so you can click compare providers, and actually, I'm gonna just cancel out of this. Let's say that you wanna take out a $15,000 loan. Check out how it actually goes through and breaks down all the different lending opportunities that you have with the APR right there, the loan term options, the credit scores that they accept, and you have everything in one place. This saves you so much time between going through different lending options, and you can just go straight into comparing. And then once you identify which are your top 1 or 2 options, I'd probably say even your top 1 option, that is when you can go ahead and really apply, because that way it prevents you from getting a hard inquiry on your credit report. And it even kind of ranks here like the Best Money score, so you can see all of that. One thing to keep in mind is, of course, Best Money has some partnership affiliations with some of these companies. So of course, they are super transparent with that, and you should keep that in mind. But typically, this really allows you to go to like a one-stop shop to understand what is available out right now in the market and ensure that you're getting the best deal. Here it even allows you to toggle. So let's say you have an excellent credit score, you can see how the APR might be a little bit different. And then of course, this accounts for those origination fees. You can see the different popularity, like how the Best Money total score is ranked. You have your brand reputation and you have your features and benefits. So let's assume that I'm gonna do a $15,000 loan with SoFi, which seems it has 9.9. You can click Get My Rate and then just log in, give information. This is the key, no impact to your credit score, and you can get personalized rates in 60 seconds from a variety of different lenders without having to go through the hassle of doing it one by one. That is a huge time saver, and it actually helps you a lot to understand your actual rates that you can get in the market today. So in conclusion, these are some super important things to keep in mind when you're out shopping for a personal loan or a mortgage or even a car loan, anything like that. These are super critical, important things that you have to take a look at. Some few tips before you go on your journey is, number one, make sure you pay attention to the different term lengths. A 15-year mortgage is not the same thing as a 30-year, same with a 5-year loan or a 7-year loan. All of those things matter. You're paying longer, you're usually paying a little bit more interest. You really have to pay attention. You can use tools like AI, like on Claude, for example, and it'll actually break down how that looks for you. I personally use that all the time. Make sure you check its work. Of course, AI can make mistakes, but that is one quick way of you understanding exactly what that means for you in your specific case. Of course, you're gonna have lower monthly payments with a longer term, but over time, you're paying more interest. So that's something to keep in mind. Another thing is when you're looking at different lenders, and when you're looking at different lenders, you wanna make sure you pay attention to how quickly they fund the deal, right? Because that can make a massive difference for you. The other thing is those fees that they charge. How do they charge those fees? And then lastly, are there fees that they charge for prepayment? So let's say that you get some money, you win the lottery, and you want to pay off the loan. Some loans don't allow you to prepay unless you pay extra fees on top of that. So if you're planning on paying it off earlier to pay less in interest rates, you want to make sure that you don't get caught in a situation where they charge you more just for paying it early. So those are a lot of different considerations you have to keep in mind. I personally have gone through things like this in the past. I've gone to a car dealership and tried to get a car, and they're quoting the interest rate instead of the APR. And then when it's all said and done, I'm paying way more than I was expecting because they add all those additional fees on top of that. So make sure you pay attention to that. Make sure you use websites just like the ones I was showing. Make sure you're checking out Best Money because that really gives you a comparison of all the different loans possible that you can get for your credit score and what's available and what exactly kind of loan that you're looking for. Best Money will save you a lot of time, and it's super helpful. Well, that's pretty much it. Those are the main tips that I have for you today. Thanks for hanging out with me on the Personal Finance Diaries. If you found this useful, don't forget to subscribe. We're all about making smarter money moves. See you next time.